Hello, everyone. Welcome to the webinar today. So glad to have you with us. My name is Alexandra Alvarado. I'm the Director of Marketing and Education here at the American Apartment Owners Association. And today we have not one, not two, but three insurance underwriters to talk to us about rental property insurance in 2026. So basically all the experts you could need to know exactly what's happening in the insurance market. What are the current risks and opportunities that you can take advantage of this year? Certainly every year has been a little different in insurance. I'm sure a lot of you have felt some premium increases. So we're excited to get into all of that today. So with our speakers here, you can see their faces. We have Courtney McCabe, the underwriter at Honeycomb Insurance. We have Tim Puffer, who's a senior underwriter at Honeycomb, and Stephen Heck, who is also a senior underwriter. So glad to see all of you on here. Each person is going to have a different section today. Then afterward, we will have Q&A as well. So I hope you stick around to the very end because we also have a little surprise offer for some of you here on the webinar today, courtesy of Honeycomb. So if you stick to the very end, we'll show you what that offer is. With all that said, a couple other things, we have this all being recorded. So if you miss anything or you want to share it with someone you know, we will be emailing you the recording, the slides, the speaker's contact information tomorrow. So keep an eye out for that as well. And then our agenda today. So what are we talking about? Key forces driving the insurance market in 2026, top risks that are facing rental property owners today. What are your options in a volatile market? What are some of the strategies to minimize premiums and coverage gaps? And lastly, as I mentioned, we'll do the Q&A and give you guys the option to request a quote if you want. So with all that said, I'm going to hand it off to our speakers to take it from here. There is a poll question. So the first poll question is, have you seen a premium increase in the last 12 months? So yes, significantly. I hope not too many of you. Slightly no change, or if you're not sure, then definitely a good time to be on this webinar and talk about where your premium should be. So I'll leave that there for a little bit and hand it off to our first speaker here.
Hello, everyone. So I'm Stephen Heck here. I can't see quite what the poll results were, but I can tell you that I personally just got my, oh, there you go. So significantly, there we go. Yeah. So the vast majority of us have definitely seen an increase. Yeah. So I'm similar. I'm in the same boat. I just got my personal homeowners insurance and personal car insurance, and it was up like 25%. So I can definitely empathize. And I think that's what we're basically talking about here is just going through what's driving that, specifically in commercial insurance and real estate industry, apartments, condos, single family rentals, really just the kind of the whole habitational market. How is that being affected? But certainly we're no, strangers to also having the similar effects from the insurance marketplace. So if we can go to the next slide, I'm going to kind of take it through the first section here. So just a quick overview of myself. So I'd handle the region. I sit in Texas. I handle the Texas region, Arizona, Utah, soon to be some other states. We're growing like crazy here, which is awesome. But I'm a senior underwriter at Honeycomb. I graduated from UT Austin, and I've been in Austin ever since. I've been in commercial insurance for almost 20 years, and I have a wife and a crazy toddler at home. So forgive me if I look a little tired, but that is life with a little one. So, but yeah, what I want to speak to here in this first section, just kind of what's driving, the insurance market and kind of how did we get here? Kind of in a non-aggressive way, we want to kind of scare you a little bit to make you, if you don't already know, but just to kind of understand the forces behind the insurance market, and what kind of events have been taking place, so we can kind of understand the backbone of the insurance marketplace and kind of again where we're at. Right now, we are considered in a hard market, or at least we've been in a hard market for the last several years. We are transitioning into a softer market. But what a hard market technically is, it's just characterized by like higher premiums, which again we just noted there in the poll that we're all feeling. We have stricter underwriting conditions. There's a decrease in capacity. Capacity is basically just the availability of coverage. And there's just less competition, right, amongst insurers. So a lot of carriers are changing appetite. They're pulling out of states. And so that's what we've been in the last few years. There's a variety of reasons for this, a few of which I'll talk about, but just kind of a high level overview. There's been underpricing over the years. There's been a lot of rising claim costs. This is with inflation, repairs, replacement costs, that kind of thing. Social inflation, which is a huge deal. We won't go into much detail in this particular presentation, but you could probably talk about that for 5 hours on its own webinar. It's essentially just the everything other than economic inflation, and we'll touch through that again through some other slides. The reinsurance marketplace is becoming a little more expensive. It's kind of like insurance for the insurance companies. There's capital losses in the insurance industry, and then these cat losses. And so that's what these next few slides are going to be about, is these large cat losses and how that cat modeling affects how we price risk. But again, we're kind of heading into a softening market, but the pressures still exist there. So this slide here there's some big numbers on here. I wouldn't get too caught up in the trying to figure out what's that the GDP of a small country. It probably is, but these are huge numbers. And what this essentially is saying is that these cat losses, it's any losses that are over $1 billion. It's kind of what this is. Not all total losses or damages in the world. This is specifically for cat losses. These are losses related to wildfire, windstorm, tornadoes, flooding, just major weather events. We're at about 300 billion global economic damages in 2025. That's actually down from about 415 billion in 2024. I'll explain why that's kind of important to the industry, right? So why are we looking at specifically catastrophe losses? I will say this doesn't represent every loss, right? These are the largest losses, and this is kind of how we gauge pricing in the industry. But like we had a huge flood event in the Hill Country. It was devastating. It was back in July of last year in Texas. And that actually did not even reach $1 billion, which is crazy if you live here, that we were impacted significantly for someone, but that didn't even reach $1 billion, right? So that's again just kind of talking to that we're speaking with these larger events, but that certainly is not the full picture of the insurance industry. But it helps us because it's all the percentages tend to be relatively similar. One of the bigger items here to look at is what we call the protection gap. Essentially, what we're saying is that of the damages that were caused by catastrophe losses, these large events, less than half were insured. And could be a variety of reasons for that, right? But only about 130 billion of the 300 billion was insured. So there's a large coverage gap. So we're trying to make sure we can kind of, from everybody's sake, we can kind of help bridge that gap. And it could be underinsurance, it could just be lack of knowledge, it could be lack of capacity, but it could just be pricing, right? Some people just want to self-insure, but there's a huge coverage gap there. Another important note here is just we'll talk about this here in the next few slides, but SCS, what we call SCS, severe convective storms, specifically that's wind, hail events, tornadoes. Again, sitting in Texas, anywhere in the southeast, you definitely are impacted by wind, hail events. Drove over or close to 50% of the insured losses. So again, we're talking about billions and billions of dollars specifically for one cat style of event in the SCS. And then the United States alone. So this is another interesting note, just that we account for 3/4 of all the cat losses globally. Now those are insured cat losses, and there could be a variety of reasons for that. Again, we have large hurricanes. We had those floods last year, those devastating floods in like the Carolinas. We had the largest global event for insurers this year was the LA wildfires. That was the Palisades and Eaton fire in January. I'm sorry, that was 2025. Keep forgetting we're in 2026 sometimes. But that cost about 40 billion. And that, again, just being in the United States, it could just be the fact that we have more availability of the insurance of insurance. It could also just be, again, more people have option to purchase insurance here. But there are a lot of cat losses in the United States specifically. This graph, again, lots of kind of figures and numbers here, just a more visual representation of what the global cat event crisis kind of looks like. You can just see that there's been a steady rise with a really large increase in the last 20 years or so of that green portion. That green represents those SCS events, again, like the wind hail events, tornadoes, kind of heavy, really violent thunderstorms. And again, there's a variety of reasons for that. We're going to go through some of those a little bit later too, but just high level, there's population shifting and there's population growth to center, like, population centers or areas and regions that are more prone to these SCS events, places like, again, Texas, Colorado, Tennessee, Georgia. And so essentially there's just more property. There's just urban sprawl. There's more property that sits in the path of these large violent thunderstorms. There's also a lot of activity that happens after these storms now that wasn't maybe taking place, even 10 years ago, 20 years ago. And that would be like the solicitation of contractors or insurance adjusters. So all of a sudden there's like somebody knocking at your door. You may have had one of those after a big hail event. And these just increase the frequency and the payout size of the claims. And then climate influences. I won't get into like a global or a political discussion about climate change, but research certainly is suggesting that storms are getting bigger and stronger and more frequent. They're more widespread. There's hail swaths that are impacting multiple states at a time. They're larger, more organized systems. Again, living down here, we're coming into the hail season, and we're starting into that in the next few days. And you can certainly, like, the more the warmer it gets, the more violent these storms get. So again, just a more deeper dive into maybe what we're looking at here with these increasing catastrophe events. Another kind of data slide here, and just talking to the catastrophe specifically events, not necessarily as much the numbers, but there were in 2024, according to the National Oceanic and Atmospheric Administration, there were 27 major events. Again, touched on that earlier with like Hurricane Helene with the Mid-Atlantic, all the floods and the damages that happened from Hurricane Helene. That was almost $80 billion just in itself. Excuse me. Also, Hurricane Milton was about 35 billion. 2025, there's not updated data from the NOAA just yet, but from a different source, Climate Central, there's 23 events. So as we talked about, catastrophe events and payouts have been a little bit lower this year, which is overall a good thing, but still we're trending in, billions and billions of dollars worth of damages. And we just touched on that with the wildfires. The largest global event was those Palisades, Eden, and the LA fires. An interesting data point here is that 2025 last year ranked as the third highest year for billion-dollar weather and climate disasters, ironically, after 2023 and 2024, right? So although we're a little bit lower than we were last year, the trend is still there, that these catastrophic events are increasing, as we saw in that previous slide. Over almost close to 1.5 trillion of losses in the past 10 years. So a huge huge impact. And really what this really translates to is, from an insurance standpoint, we use this cat modeling to basically price risk. So we have these catastrophe models. We try to simulate these plausible catastrophic events based on all these different kind of scenarios. We have the different parameters. We got the weather patterns, geography, geology, that kind of thing. Then we put these into the model. We estimate the damage to insured properties. We basically have to do a loss estimation of what that looks like. And then those models generate outputs and allows us to then assess the likelihood and the severity of the potential losses. So what these cat modeling essentially does, long story short, is we use cat modeling to help evaluate and price our risk. So the more cat models the more cat events there are, prices generally need to increase to keep up with it. If it was all just completely steady, over the past 20 years, maybe there'd be more of an explanation of why prices are maybe able to decrease or increase. But it's kind of this volatility, and you have to just understand that eventually, right, as an insurer in this marketplace, you basically have to predict the unpredictable. And it's becoming more predictable to predict it because we know that the trends are increasing. So the this slide, now we're taking a little bit of a shift here. This is more in relation to inflationary factors. So just another reason of what, kind of what's driving different factors in the marketplace, the increases in price. I think it's pretty, you know, obvious, and we all are, feel the impacts of inflation, not only just with insurance, but obviously in our own personal lives. But it affects, how we navigate, the market and how we price it. This is from the Federal Reserve of Economic Data. This is their inflationary factors as it relates to construction. I would say the kind of the main visual here is just to see these different spikes. You can see right in that like grayish column right there. That's when COVID happened. So obviously, once that happened, we have a lot of different pressures on, supply chain and labor shortages and all these, different factors that all of a sudden, boom, prices are increasing. So I got in like right after the pandemic to do. I think a lot of us did, for remodeling, and we were like sitting at home, and it went to Home Depot and got all this, and then all of a sudden, boom, like everybody was doing that, right? And then it just skyrocketed. There was just a lot of pressure. So we've seen that over about 40% increase surge in prices since 2020, and they're just remaining elevated. There's another little spike there that it was like that ship called the Ever Given. It ran aground in the Suez Canal. That was in March 2021. But it's interesting how just like one event can really impact the global market. So, it seemed to be in when it happened, maybe a week or two long, news issue. And then all of a sudden you're looking at, you go to Home Depot and something's costing 20% more. So it's just interesting how these seemingly little events can cause big spikes. More recently, we're in an active situation with the war in Iran, right? And I think that this data doesn't extrapolate, but it's just again proving that you've got to predict the unpredictable, and essentially there's always going to be pressures on inflation. This is going to continue with the oil prices and that kind of thing. It's hard to predict what's next, but certainly the events are happening, and pressures on inflation continue to increase. And specifically also in the last couple of years, we've had a lot of tariffs, right? So the tariffs are impacting that, maybe not on a singular level, but over the course of several years, it definitely will cause a surge in prices. Again, just more of the same here about inflation. So, what does it really impact as far as insurance prices and as it relates to the marketplace? We talked a little bit about obviously the material increases. There's also the labor shortages, and there's supply chain backlogs. Again, we got tariffs. Generally, we have higher home values. As home values increase, the cost to replace that tends to increase as well. So the severity of the losses have increased because the cost to replace them or repair them has also risen sharply. Interesting note here, I read this the last few days, was that the same hailstorm, the same hail event today might produce 2 to 3 times the insured loss that it would have in 2005, even with identical buildings, right? So that's even in the past 20 years because of those factors we just talked about. Their cost to replace them is increasing drastically. This, just at the end of the day, it impacts our loss ratios as insurance carriers. No one wants to hear that, right? That insurance companies are also businesses, and we need to make some money. We can talk about that another day, but at the end of the day, without making some, I would say it a different way. If we're losing money and there's no way to operate a business, the insurance marketplace, the prices are going to have to increase as well. But there's going to be less capacity, right? So more insurance carriers can't just stick around. The ones that are left may have to increase their prices. So there needs to be a balance for all of it, but it does impact our loss ratios. And as an underwriter, we're underwriting a property. We're trying to determine the appropriate rate based on what the loss is. And if those losses are increasing and the cost to replace them are increasing, we just have to adjust where it makes sense. That ultimately can translate to a variety of different things, but at the renewals, again, it could lead to higher increasing in prices. It could lead to some carriers, as I said, exiting the marketplace. And again, just as a reminder, it's just again, not everybody wants to hear it, right? But it's a business, and we've got to just stay afloat. And so I think the last few years, again, was just trying to catch up to what was happening in the claims and the losses. And now again, we're hopefully jumping into a more softening market. So hopefully with the renewals, it won't be as big of an impact. It impacts the life cycle of claims. So we talked a little bit about just like the claim structure as it relates to replacement costs and when you're replacing something, right? So if you have settlement costs that are rising or replacement costs that are rising, we need to be more cognizant of how that's impacting our bottom line. The social inflation is really real. So again, I would think about it this way. It's like if you go to if something if a claim turns into a lawsuit and you go into a courtroom and and actually my wife works for a law firm, and so we have these conversations a lot, but there's an insurance company sitting on the other side and you have a jury. The social inflation factor of many times, the jury doesn't really care whether who's at fault or who's not at fault. They just say insurance company, instead of $500,000, it's going to be $10 million because we're just, we're upset about what's going on in the marketplace. And that's fair. There's a variety of reasons for that, but that ultimately does create pressures, and it creates more pricing pressures on the carriers and everyone kind of in general. It all kind of matriculates. So social inflation is a huge deal, and as we're dealing with these claims and lawsuits, just certain jurisdictions and environments are also very litigious. So it just increases time and increases dollars, and just increases a lot of the pressures on our premiums. Another little fact here is just, as 2022 and 2023, the last couple years, we generally were pretty underpriced. I actually saw this today. So we were at like 50% of the value that we probably should have been. In other words, the apartment complex maybe was 2.5 million. We probably should be about 5 million based on inflationary factors. That's just like straight building limit. But what do we do in that scenario? So do we jack up the limit and then all of a sudden there's a pricing impact, on an immediate pricing impact, or do we slowly increase that rate? But what happens if the apartment complex, there's a fire and we have to replace it? Then are they underinsured? It's like there's just all these different tough factors that's facing kind of what we're doing. So we again try to have those conversations up front with the agencies and with the insureds to make sure that we're appropriately priced and appropriately at capacity and at insurable value. But we're just trying to make these decisions as these portfolios are underpriced. So we're just different pricing strategies. We just got to keep up with inflation. If we don't, we can quickly find ourselves operating at a loss. And we can just go on and move on to the poll. This is just another interesting point here, just that even without cat events, inflation also has proven to be a threat to profitability. So, but let's move on to the poll here.
Great. I might have clicked that a little too soon. But here, just asking which risk worries you the most for your rental properties right now. I guess it depends a lot on where you live. Southern California here, I would say wildfire. Today's a little windy and it always makes me nervous. Flooding, winter storms, aging buildings, and other. I'll leave this up just a few more seconds here. Got a hail in Colorado from Michael in the chat. Ooh, I rarely have gotten hail over here. So that certainly is one not on the list and probably could fit into other. Hail can definitely be destructive. So let's go ahead and see what the results are here. So it looks like aging building is number one. Yeah, I mean, a lot of you nationwide, right, would have buildings that might be quote unquote older now. And then we also have wildfires coming in second, other close behind, and then flooding and winter storms behind that. So wind in Florida, says David. Earthquake, says Fred in the chat. So lots of, earthquake's another big one for sure. Hopefully there's no big earthquake coming near us at any point soon. That's always the California wish, right? All right, I'll let you guys take it from here.
Great, thanks. Yeah, and I would say again, we touched on it a lot, but being in Texas, certainly wind, hail, and those SCS events. Interestingly enough, wildfires are now becoming a thing down here, and I think it's just and we're going to talk about this here with just the increase in population and population migration patterns. Whereas maybe one event might have impacted like a few homes, now it might impact an entire subdivision or an entire community of homes. So certainly, that's affecting a lot of the pricing too. But yeah, when you have a giant hailstorm down in Texas that now covers the entire city of DFW or the metroplex, you're certainly going to have a lot of folks raising their hand trying to figure out kind of what's next and how we can protect. I don't know how necessarily you protect yourself from a hailstorm, but again, it just an interesting poll to kind of see what impacts are people feeling in different parts of the country. So as we kind of transition here to what we were just talking about with the population trends, so this slide is really just showing you the different densities within each state, and it's no surprise. I mean, this basically just telling you what the largest populations sizes are. What's interesting here is that the UN just published a world report, a global report on the growth of city populations. And the study estimated that 81% of the world's population now either lives in a city or a town. So this doesn't necessarily mean, I know, like, again, going back to the pandemic, a lot of folks were moving from like the actual city centers out a little bit. It's still, most folks were just going to maybe a home with a yard, or kind of being away of like a little bit social distancing. It's not necessarily they're completely moving it. Now, some did, but it's not like everybody's moving out to the middle of the sticks in the middle of the countryside. It's like take DFW for example. I mean, that thing is half the size of North Texas. So, but the metro areas, generally speaking, people are still in those areas. So yeah, there's just as the census kind of reiterates, and I'm sure when the next one comes out, we'll see even more of the trends. But it's just revealing a shift in population. So the patterns we're recognizing right now is basically that we talked a little bit about this, but where they're kind of shifting into the different states that actually have a large SCS exposure, they're really the most climate vulnerable. So we're trying to, again, just as it relates to like the insurable aspect of this is as more folks are moving into urban dense areas, there's just, again, more property, more option, more availability for losses. We call it suburban sprawl, but as you can see, it's like tract home neighborhoods and more single family housing developments and that kind of thing. And also as insured values per home increase as well, the replacement costs increase. There's just more property and more values that sit in the path of these larger storms, which produce more insured losses. Again, on the flip side, I saw this with some of these other states, but this is just about like aging infrastructure and that kind of thing. So you have some of these other states that are kind of experiencing different demands. This quote, pretty self-explanatory here. It's just not about the actual building; it's actually about the people and the moving and the migration patterns. So kind of what we just talked about in that previous slide. And then just lastly, just to kind of wrap this section up. So what's kind of behind the shift and what's causing it. So essentially, carriers are starting to withdraw in certain areas and kind of more extreme scenarios, just because they're limiting business. They need to exit certain zip codes. They might be non-renewing. Appetites are changing and that kind of thing, just because the losses are just becoming, in some cases, out of control or just it's hard to keep up with. Or those that are left, we're doing a lot of stricter underwriting. We're tightening guidelines. We might be doing something like raising minimum standards for roof age, kind of targeting, getting more granular on what exactly is impacting our losses, and then we're adjusting from there. And so it's just increasing deductibles and for certain policies, limiting coverage options and that kind of thing. Now there is another marketplace where we actually offer both Honeycomb, it's admitted, and E&S or excess and surplus lines. We can kind of talk about that more later, but there are marketplaces to kind of fill the gaps where maybe we certain carriers maybe don't want it in a certain program. Maybe we can push it to a different program, maybe some different pricing, right, or different forms, but at least there's going to be some coverage there.
Okay, here's our third poll question. When was the last time you compared insurance options for your property? I like how one of the responses here is it's been a long time. You don't even remember how long it's been since you had a quote last. I hope some of you have been shopping around because of the increases we've been seeing. So definitely a good idea. Within the last year, seems to be in quite the lead. So I think some of you are definitely on top of it. 1 to 2 years ago and 3 to 5 years ago seems to be pretty split. I'm gonna go ahead and share the results here in just a few seconds. Let's get your answers in and give you guys about 10 more seconds here. Tim, any thoughts on the results here?
Yeah, no, I usually shop my insurance every 2 to 3 years, just gives enough time for yeah, most people within the last year. I think that's probably more common in, marketplace we're in where, prices are increasing, things like that. I usually like to leave a couple years, give some time for, some, mini cycles to kind of go through. Carriers are changing appetite all the time, pricing, consistently. But shopping every so often is certainly a good idea, good, prudent, when you're looking at your overall real estate portfolio when you're trying to control expenses. So,
Yes, absolutely. Michael says it's gone up so much in the last 3 years. You have to. And also Sammer and Didi asking about coverage in California and Colorado and states. So we'll get to what Honeycomb covers, but
sure.
Colorado and California are included, is my understanding. So I'll answer those questions real quick, but we'll address a little more about what Honeycomb does towards the end here.
Yeah. Cool. All right. We're gonna move on to talking about some risk facing you guys as property owners on a more micro perspective here. First, introduce myself. I'm Tim Puffer, a senior underwriter here at Honeycomb. Been in insurance for a little over 12 years. I've also invested in some real estate myself with a duplex and a small storage facility. So, I know what you guys are thinking about as it relates to not just insurance, but overall portfolio management with real estate as well. So, next slide here, if we could. So kind of to tie in what Stephen was talking about a little bit with some of the convective storms, things like that. We look at as underwriters a lot of different data sources to try to make good decisions as it relates to an individual property and whether or not it's an account that we want to take on. One great piece of data for us is the FEMA National Risk Index map. So they'll put together, every year where they'll generate an overall index for the entire country and, drop it down for specific areas. And they're factoring in wildfire, hurricane, freezing, hail, I think landslides on there as well. So this is a good report that we reference, and I recommend that you guys take a look at it as well. So moving on from that, kind of on a more regional basis of things, that we look at, we have people from all over the country on here, but in Florida we have some downstream effects. Carriers exiting the market. 10 plus carriers have exited due to hurricane losses. California, we have wildfire concerns. 1 in 4 homes now lie in a high or very high wildfire zone. Additionally, in California, you got habitability lawsuits, on the rise, and a lot of cases, juries are awarding, policy limits. So these are very high, dollar amount losses that are coming through. Those could be for mold, pest infestations, maintenance concerns for those properties as relates to habitability concerns. Texas and the Midwest, big for hail and wind events. So we are tracking those, very very closely as well. So I think as property owners or property managers, it's important to know your portfolio and some of these larger risk factors depending on where it's located in the country. Know about them and be thinking about ways to mitigate your loss exposure on those properties. So that's a little bit of a macro within the micro. what can we look at on an individual, property perspective of, hey, what can I do on my property, to, help position it best to, have Honeycomb, consider this property. Many of you have probably seen older properties are facing, heavy scrutiny with a lot of carriers out there, with age restrictions if they're over 30 years, things like that. Honeycomb, we don't have that restriction as relates to building age. We are, however, concerned with the maintenance of the building and the premises and building updates. So we're looking at, was the wiring and electrical panels updated? Is the plumbing updated? Are the interiors, well maintained? Those are things that we're looking for. And if, those aren't, updated, that's a red flag for us. Another big piece of that is the deferred maintenance, like I talked about. So does the property have good curb appeal? Is a fence falling down? Is there peeling paint around the window frames, around the door frames? Is there cracking, asphalt and concrete? Are the downspouts draining in the high foot traffic areas? That particularly affects us in the Midwest and in our northern states of we get a small thaw during February, but it freezes back up at night. Potential slip and fall hazard that we're looking at there. We also look at, if stairs are uncovered and accumulating snow as well. So we look at and to make sure those things are well maintained when we're assessing properties. Good rule of thumb is, we ask ourselves as underwriters is, would I live there? Would I feel comfortable living there from a maintenance perspective? And, in general, if we would, it's a property that, at Honeycomb we would consider. Good tip on deferred maintenance, just, present your property as best you can for, insurances, keep records of all your maintenance and upgrades, keep the invoices, before and after photos. It just, shows paint a good picture of, hey, I'm maintaining my property and put it in the best position to, have a good risk profile from an insurance company perspective. Moving on to roofs. I'm sure that you've went through it or have heard about it from other investor friends. Roofs are under heavy scrutiny. At Honeycomb, we take an in-depth approach as it relates to underwriting, applying wind hail deductibles, depending on the territory it's in. This image on the left is this is an account that we do insure. On the left is an older roof, significant granular loss on it, and new roofs on the right. So we treat those differently. We do take into consideration the age of the roof, how it's wearing, type of roof surface, how tall the building is, what kind of siding we have, and work to apply an applicable wind hail deductible for the territory it's in and for the individual property that we have. Additionally, from our aerial imaging, we look at vegetation and surrounding buildings and adjacent exposures. So I think with wind hail with roofs, I think it's important to factor what area of the country you're in and be thinking about the potential of paying out your wind hail deductible in an event and put that into your property pro forma, or at least have a holdback for that and have capital ready for that. Moving on from kind of the property perspective, some liability concerns that we look at on properties is we're looking for slip, trip, and fall hazards. According to the National Safety Council, falls are the #1 source of premise liability claims. Common culprits are uneven pavement, broken railings, poor lighting, broken steps, steps without toe kicks on them, so people stepping, kind of putting their foot to the other side, slipping or breaking the step. We've had a claim where somebody broke a step like that and there was no toe kick, so a little bit less structural integrity as it relates to that. Another large piece specifically in California to pay attention to is those habitability concerns that I mentioned earlier. Making sure that the property is in a habitable condition. So make sure that there's running hot water and cold water, good electrical systems, adequate air conditioning, no broken windows, it's sanitary. like I said earlier, there's been times where policy limits have been paid out on those claims due to those systems being inadequate. Um, and you'd be thinking about two multi-unit properties, do increase exposure, more opportunity for something to happen as it relates to that. It's not a bad thing, just worth considering, especially in California, you can be subject to class action suit for greater than 20 units. So good tip as it relates to liability is, know your property, conduct regular, safety walkthroughs, look for, slip, trip, fall hazards, and you'll make sure you're maintaining, those pieces to help, lower your exposure to a liability claim. All right. We also have some regulatory risk and compliance concerns. Flies under the radar until something happens and then it hits your balance sheet. So cities are always passing new ordinances, and insurance policies are evolving to exclude coverage, unless those regulations are met. So California specifically, some of the seismic retrofit mandates, LA and San Francisco, you have to retrofit certain buildings, structurally, and they're not optional, and it has to be done. So that's something that to consider in those areas. There's also fire safety regulations to pay attention to, not just California, but in every state. Lead paint remediation, electrical upgrades, all of that will vary from city to city. So it's important to know those items, so that you don't run into any issues down the road. Um, and a lot of insurers are adding language that will exclude if a building is not in compliance with local codes. So very important to pay attention to those. I think if you tie that in with maintaining the property and keeping your invoices, things like that, that'll help you buffer your property from you running into a situation where it's out of compliance for those items. So just stay proactive on that. Keep updated on those things. If you have a good contractor you work with on all your properties, make sure they're up to date on those things and are keeping you aware of what's going on as it relates to those items. So, in summary, with all of this, pay attention to your property maintenance condition. Keep a watchful eye on everything, and that puts it in a good position to be able to insure it with Honeycomb.
Thank you, Tim. Casual introduction. My name is Courtney, and I am an admitted and specialty underwriter with Honeycomb Insurance, and I'm in California. So we've covered the bigger picture challenges and what we're seeing locally. Now the question becomes, what options do we have, and what solutions can we put in place moving forward? Next slide, please. So admitted versus E&S, like excess and surplus markets. Let's break this down simply. So admitted carriers are licensed and regulated by the state. That means they must follow strict rules on rates, policy forms, and claims handling. If the company becomes insolvent, the state guarantee fund helps cover claims. There are no surplus lines taxes on extra E&S fees. If there's a dispute, policyholders can go to the state insurance department for help. In short, more regulatory oversight and built-in consumer protections. Now, non-admitted carriers, also known as E&S, excess and surplus carriers, operate differently. They're not licensed in the same way in the state, but they serve an important purpose. They provide flexibility for higher risk exposures, such as properties in wildfire, flood, or wind hail zones, buildings with deferred maintenance, higher risk occupancies like mixed use or short-term rentals. They also have more flexibility in pricing, especially in environments where standard market rates are no longer adequate to support loss activity. If you're routed to the E&S market, here's what you should know. 1, financial strength matters. Many E&S carriers are backed by very strong, well-capitalized companies such as Berkshire Hathaway and AIG, but you should always review the carrier's financial rating. 2, policy terms may differ. Coverage may not mirror a standard admitted form. Pay close attention to coverage limitations, exclusions, or sublimits. In California specifically, watch for habitability exclusions or sublimits. 3rd, additional fees and taxes. Surplus lines, taxes, and stamping fees apply in E&S. These are not present in the admitted market. And then 4, documentation is key. Keep clear records, ask questions, and understand exactly what is and isn't covered. A strong, knowledgeable agent should understand the carrier they're placing you with and help you navigate the nuances of the policy, especially in the E&S space. Next slide, please. So in a volatile market, the key is understanding that you still have options. There's self-insurance. Ask yourself, do you have the financial reserves to absorb smaller losses? If so, it may make sense to retain more risk rather than transferring every dollar to insurance. 2, increase deductibles. Taking on higher deductible shifts more responsibility to you, but it can lower your premium and also improve eligibility in tighter markets. It's about balancing cash flow with risk tolerance. Diversify coverage. You don't always have to bundle everything together. Separating general liability and property coverage can sometimes create cost savings on open up better market options for you. You also want to review annually. Commercial insurance isn't like a set it and forget it. Markets change, appetite changes, pricing changes. Reviewing your portfolio each year ensures you're aligned with the best available option at renewal. And unlike personal insurance, loyalty discounts aren't typically the driver. The priority is maintaining continuous coverage without lapses. For your investor tip, you always want to review your policy carefully. Exclusions and sublimits can create significant out-of-pocket exposure after a loss if you're not aware of them up front. And now we're going to go to our poll for next slide.
Okay, wonderful. So quick poll break. How concerned are you about your insurer dropping coverage in the next few years? Certainly, we've seen it happen already. Someone was in the chat saying how in Florida there was quite, a lot of issues obtaining insurance and that it is softening a little, thankfully. But the last 5 years were certainly rough. So I'd love to see what you all think about how concerned you are about this potentially happening to you. And it looks like very concerned is in the lead. Oh, I hate to see that, but that is why we're on here, right? To see what we can do if that's the case. So let me go ahead and end the poll here real quick. Just a few more seconds to get your answers in. All righty, let's share the results here.
I'm definitely with you guys too. Very concerned. I'm not gonna lie. As I said, I'm from California. I live in California. I live in a wildfire zone, so
Same.
I gotta admit, like every year, like my renewals as that April, every year I'm like, what's gonna happen? Like I won't be surprised if I do get dropped sometimes. Like that's why I'm like, yeah, I'm very concerned. Please, next slide. So finally, given all the market changes we've explored, what strategies can you use to position your properties for success going forward? Next slide. So some smart strategies to minimize premiums and coverage gaps. So one, we're going to look at property maintenance and risk mitigation. We want to implement proactive maintenance on all major systems. So we're talking HVAC, plumbing, and electrical. You want to regularly assess roof condition and address repairs early. So like in the Southeast, watch for large overhanging trees in northern exposure aging. In Texas to Midwest, we're looking at roofs that face high winds and extreme temperature changes. So you're going to want to invest in safety upgrades like fire extinguishers, suppression systems, handrails, proper lighting. 2, we're going to look at vegetation management and fire safety. So trim trees and excess vegetation, maintain at least like 5 feet of defensible space if you're in California, Colorado, or other Western states. I'm just going to let you know, like I'm looking at my patio, but I was going to say personally, I don't have any mulch outside. I have rock and concrete because it's not wildfire friendly. So we're going to be looking at fire escape concepts as well. So plant fire resistant vegetation. You're going to create fuel breaks to prevent fire spread. Use non-combustible materials such as rock, gravel, concrete in landscaping. You're going to want to remove dying trees and vegetation promptly. 3, you want to stay ahead of inspections. Carriers are inspecting more frequently and thoroughly. Know what inspectors look for to avoid declines or non-renewals. You want to clear hazardous areas such as like dumpster areas with old furniture, mattresses, construction debris, etc. And then for barbecues, maintain like 10 feet from the buildings, and also gas grills are preferred over solid fuel. You're going to want to lock away chemicals and ladders to prevent attractive nuance claims. And then 4, know your coverage. Review policies with your agent. Ensure coverage matches potential losses. Eliminate unnecessary coverages such as excessive garage limits. And then you're going to want to position your property for underwriting. So maintain clear records of updates, maintenance, and claim history. You're going to want to absorb small claims when possible. Insurance is for major losses, not routine maintenance. And then 6, work with the right partners. Choose an agent who understands landlord-specific risk, local market conditions, and carrier risk appetites, like meaning admitted versus not admitted. Consider a reputable property manager. They help maintain your property and reduce risk exposure. Next slide, please. And lastly, let's take a look at the current property insurance market and what it means for residential investors. First, rate increases are continuing to moderate, which is a good news. According to the Council of Insurance Agents and Brokers, premium growth has slowed sharply in 2025, especially for well-managed residential portfolios. That's good news for owners who have taken proactive steps to maintain their properties. The reinsurance market is also softening significantly. At the start of 2026, global property catastrophe coverage saw one of the largest declines in rates since 2014. Reinsurers entered this year with strong profits, abundant capital, and has translated into more stable pricing and fewer surprises for property owners and managers. We're also seeing capacity return to the market. The higher premiums of the past few years have attracted new capital into residential insurance. At the same time, existing carriers are becoming more comfortable with their risk selection, and some are even re-entering markets or expanding their appetite. As competition increases, it's leading to broader options and better terms. Now, while the overall market is softening, regional differences remain. In areas like California, wildfire exposure continues to drive rate increases for some carriers. So even in a generally soft market, local risks do matter. For investors, the takeaway is clear. The market is stabilizing and opportunities are emerging for well-prepared properties. Proactive risk mitigation and clear maintenance records remain key. Partnering with experts who understand both admitted and non-admitted markets and who can navigate the nuances of reinsurance pricing will position your portfolio to take advantage of these trends. Here at Honeycomb Insurance, we're here to help. It's what we do. We have local experts in the markets we write in, offer options in both the admitted and non-admitted markets, and use cutting-edge AI modeling and advanced technology to assess your property and provide the coverage you need at a fair price. Thank you.
All right, thank you so much, Courtney. Great job to all of our speakers. I'm going to have them come on here for Q&A. I saw some of you putting questions in the chat. If you could instead put them in the Q&A box, that would really help us out to keep that in order. We are getting quite a few questions. We may not be able to answer all of them, but don't worry, we will be answering any we don't answer offline. The Honeycomb team will be sent the questions so they can follow up with you. I also want to tell you all about the offer that we have. So this is the surprise that I alluded to at the beginning. If you get a Honeycomb quote, we will be providing an entry to win an AAOA free Pro Plus membership. So some of you might already be a member. So then if you are already, your next year will be comped. You can scan the QR code here. I also am entering in the link in the chat. So if you wanted to do here, a click on the chat, or you can scan the QR code, whatever's easier for you. The Pro Plus membership includes lots of benefits. So, a couple free tenant screenings, free education, free forms all year. So go ahead and take a look at that if you can for a moment. And actually, you don't even need to get a full quote. You just have to submit the form here on the QR code. So I hope you'll take advantage of that. So let's dive into some questions here. So a question that came up a few times is, who is Honeycomb? An insurance broker, an insurance provider. So let's start with that so we can get a good basis here on who Honeycomb is. And I'll let any of you take it away from there.
Well, Honeycomb Insurance, we are a company. We write insurance for residential properties like single family homes. I saw that actually was one of the questions,
Yes,
but
it was.
rentals. And we do apartments, condos. I was to say we're an insurance company. Hope that's simple.
Yes, yes. Thank you for providing that. So, and then lots of questions on coverage. So we will be sending over the states, as I believe was mentioned by your team, there's 22 states that Honeycomb covers. So we'll give you all the list there after the webinar for those people asking. So let's get into some of the more nitty gritty of the insurance world here. So Kelly had the first question here. I am with a property management company, and I find it harder for companies to add us as additional insured on the owner's policies. Why is that now such an issue? Have you all seen that on your end?
So I think it's important to look at the specific forms in the insurance policy. Some language does automatically list real estate manager as an additional insured, and thus there's no need to list the property management company as additional insured separately. So I know other carriers, us included, with kind of it can be in the policy language depending on the state. So I would encourage reading through the forms and making sure what those stay.
Okay, good advice there. We also have another question. I have rental properties that are insured. Sometimes I will go years without filing a claim, and there are others just like me. When I did file a claim, my insurance went up and one company dropped us. Why?
I mean, I think that's the age-old question, right? I think we all deal with similar, um, yeah, similar situations. I mean, like I said, I haven't had a claim in over a decade. And even the one claim I had on my car was something very minor, but I got increased on both home and auto. So that was, again, personal insurance, but a variety of factors, I would say, you know, the several slides we went over kind of with catastrophe events and how I think social inflation certainly is impacting pricing, but I would also say that like there's real reasons for why, but there's also specifically on like a more granular level, you may have your property or your risk profile may be such that it warrants a lower rate. And so I would just say that's part of this conversation, right? Is to get an agent and get with a carrier that has the ability to do that, and it can kind of talk you through maybe your specific situation. And like I can tell you from Honeycomb standpoint, we have the ability to look at a risk by risk. That's what makes us, I think, one of the things that sets us apart and makes us unique is that we can look, like I may see a property in DFW and it's an awesome risk and I really want to write it. I can do that, and I can do that at a lower price than I can maybe with maybe the neighboring house right next door. But a lot of other carriers or insurers, it's just like a blanket statement. They're like, we're going to increase every home in this swath in this giant region by 10%. We're gonna increase your deductible by, we're gonna go from 5,000 to 10,000 on every single apartment complex in this region. We don't do that. Certainly with, we make decisions that where it's appropriate for, the direction of our company, but we're risk by risk. So I think it's just a part of like, just trying to make sure you're staying educated, staying engaged, what you're doing like here, and then getting with the right agent that's able to, kind of put you in the right position. That's what I'm doing. So my personal insurance, I got this carrier, and I'm like, I am not going to stay with them because they keep doing this, and so I'm just going with a different agency, and they're going to get me with a good carrier. So a lot there, but I think it's a case by case basis.
Yeah, absolutely. And Tim mentioned it. I believe it was you, Tim, that you said loyalty is not a thing. And so, they don't necessarily reward you for staying with them necessarily. And I also want to emphasize as well that Honeycomb is a great team to talk to and to ask questions about, your options, about what Honeycomb does. So again, this QR code is probably one of the best ways to get in touch with the team, or the link that I posted in the chat as well. So another question that came up is where is or what is the best way to get insurance quotes for a fourplex in California? So I think in general, when you're doing the whole quoting process, I mean, what should our members do? Where should they go first to start with something like that?
They can always go to our website for Honeycomb Insurance to request a quote. They can even work with any agents that's affiliated with us. I was like, the good news is we do our fourplexes. I was like, I review them constantly. So
And
yeah,
they can use that QR code too, Courtney, that we have on the
yeah,
screen.
I was gonna say the
Yeah.
QR code has
QR
the
code's
direct
Go
everything.
link
Honeycomb
there.
Direct. Yeah, this will get you,
Yeah.
with
Yeah.
Honeycomb Direct for us. And I'd say, if like I said, that rule of thumb earlier, if you're, maintain your property, things like that, submit it to us, let us underwrite it and take a look at it. And if we have other information that we need from you, we would get that over to you and take a look at that when underwriting your
And
property.
it's quick to submit. It's pretty easy to navigate our website through the QR code. You can just go through it, and then it takes within 5 minutes to know the answer, and it either gets referred to us or you get the auto approval pretty quickly.
Beautiful. Yeah. And also, I want to mention if Honeycomb can't offer you a quote, they have a lot of partners that they can refer you to. So still definitely worth asking. Someone else asked if you
Yeah.
do HOAs and all those different questions. Do you do this? Do you do that? The QR code is a good place.
Yeah.
Yeah.
So, when you submit your property, if we can't do it admitted, like Courtney talked about, we have our specialty, side of the company that will take a look at, some with a little bit more, high risk things that we would, determine when we're underwriting it. And, like Alexander said, we do have partners if we can't, take a look at it. We work with to, help you find a home for your property. And so, just think about we do 1 to 4 unit properties, we do apartment communities, and we do condo associations. That's what we do. That's what we're experts on is the habitational side of insurance.
Good to know. Lewis is asking here, what's the definition of a midterm rental? And what's the difference between a midterm and long-term landlord insurance?
I don't know the specific definition, but when I think about, midterm rental, I think about kind of maybe corporate housing where you're furnishing the unit, things like that. That type of profile, might be something potentially we would look at on our specialties side of the house, not necessarily the admitted side. That dives into a kind of short-term to midterm rental. So we do look at those very differently. On our admitted side, we're looking at having year or longer leases, and if you're doing midterm or short term, we can send it over to our specialty team to take a look at to properly price the account for the exposure.
Great. John wanted a clarification. Did you say you do HO6 walls in for a townhome?
We do not provide HO6 policies, no.
Okay. All right. Here's another question for self-insuring. John has said, how can you self-insure if the lender requires?
Good question. Gosh, quick answer that comes to mind would just be have enough capital in the bank to show your lender that you can withstand, maybe the entire building burning down. Yeah, I'm not sure how else you'd be able to do that and get by lender requirements because
Yeah.
are very that they will make sure you have insurance one way or another. They will force place it on you.
Yeah, yeah. Okay, let's move on to another one here. A comment from someone on your team. You can also take a policy with a higher deductible and keep more cash on hand. So,
Absolutely could do that. If you have the financial wherewithal to do higher deductibles, that's perfectly okay to do.
hmm,
I
okay.
actually saw I just did one of those for a large portfolio. And so just real quick, we do single family rentals, we do condo associations, we do apartment complexes. So it's kind of the whole habitational book. But we had a portfolio of a bunch of single family rentals, and it was a price play. It was like we want the cheapest dollar that you can offer. We're very confident at Honeycomb in our coverage, but it came down to that where it was just like, hey, we want each home, let's say they were $500,000 a piece. Each home, we want a $25,000 deductible, a $50,000 deductible. We want wind hail at 7-8%. I mean, these were like which for as an insurance carrier, like, okay, we could do that. But the price obviously follows that, right? So then it was like these very cheap policies, but you have the option to do that. It's just then what happens. I think they think they're in their mind it was if the homes burn down, we want to have some coverage. Other than that, maybe we're just trying to satisfy the lender requirement, but it's like maybe a $500 policy or something like that. So maybe not the best coverage, but that is an option.
Yeah, that is interesting, right? Certainly, I think in such a challenging market, that is becoming a more viable option when the price is so high for insurance. Dan is asking another interesting question. My building is mixed use. I live in it on the upper floor. The businesses are on the ground floor, but zoned commercial. So finding insurance has been a special challenge. What do you suggest for something like that? Courtney, I see you nodding your head, yes.
Well, I was gonna say, like, at least it's a California specific rule. So I don't know if you're in California, Dan, but I was gonna say for us, in order for us to consider where the individual like lives in one of the units, it has to be under an LLC for us personally. However, the rule is different for other states with our company personally. But I just wanted to kind of give you a heads up. I could see why it's been a little challenging, but
Mhm.
yeah.
Yeah, I'd say in general that holds true, and the other across the companies that if we want it to be in an LLC, if the owners living in the building, we don't want to run into a situation where we are potentially providing personal liability for the individual in the property. We wanted to maintain strictly for the operation of the business, and we accomplish that by requiring it the named insured to be an LLC as opposed to the individual when they're living in the property.
Great, thanks for the detail on that. So we're going to wrap up in just a couple minutes. We have a lot of questions, so don't worry if we didn't get to your question. I am going to send all these questions to the Honeycomb team to reach out to you after this. Another question came up a little different, so I'm going to pull this one. Is the solar affect the pricing? Have you seen any breaks for solar on insurance?
So having solar panels on the building, they're
Yeah.
referencing. Not in particular. I mean, that doesn't it wouldn't necessarily say there would be a discount for that. In fact, in our higher wind hail prone areas, it might actually be a detriment to the property, given the cost of replacing solar panels, particularly the labor involved with removing them from the roof and reattaching. So I would say to you think about that on your properties as relates to that, depending on where you are. Because that's something to consider as it relates to, hey, if I have these, great, but might have a higher wind hail deductible due to the higher exposure.
Mm. Yeah, Mary similarly says she had a single wind claim 8 years ago. Total 25 units, 34-year-old well-maintained property. Do you cover these types of properties? Someone else saying they have a 1927 property. So it's at a certain point, when a property's older or has had a claim, what do you suggest in those cases, or what are you seeing right now with your current clients?
Yeah, so we can definitely consider older buildings. I think it just, it's going to depend on, again, case by case, risk by risk. I saw it somewhere in the chat. Someone asked if we do like knob and tube wiring, that like aluminum type wiring or pigtailed. We don't do that, but we can do like non-standard panels. So again, this is case by case, but depends on how old the building is. We're not saying that, we're not taking that hardline stance of like, hey, your building's built in 1900, then we're moving on and we're not going to do it. We certainly will look at it. It just, we want the building to be properly maintained, like any risk. So yeah, as long as you're taking care of the building, and if there's claims, I mean, at the end of the day, we're in the insurance market, right? There's going to be probably some claims every once in a while. That will also depend if if there's a high frequency due to, a certain loss event that has not been remedied. Like we've seen this with like water claims. I mean, I had one building that their remedy was, instead of like replacing the piping, they just started putting piping in the ceilings and going all, and I was like, well, that's not really fixing the issue. So but if they've remedied the issue, and we can move it from our admitted to our E&S. I mean, there's a variety of things we can do, but it doesn't kick it out if there's claims. It just, we would have to know what remedial measures were put in place, what's the quality of the property, and that kind of thing. So
Okay, well, wonderful. I think what I'm hearing is Honeycomb has flexibility, customization, definitely worth having a talk with their team if you are looking to find a solution for your insurance. Want to put the QR code up again. Sorry about that. I stopped sharing here to close it out, but if any of you want to reshare the QR code here for everyone, one last time, you can scan the QR code to request that quote. And you do get an entry to win a free AAOA Pro Plus membership. Someone asked, what is that? It's fantastic. If you're screening tenants or you need any sort of leasing form, we have 150 plus state specific forms that are approved by attorneys. We have free education. We have tenant screening that's super comprehensive that you can get for free as a member and or highly discounted. So highly recommend our membership if you haven't already, upgraded your membership. And also the Honeycomb quote here, accessible to all regardless of your membership status. And want to give you all a final reminder that we will be sending everyone the recording, the slides, Honeycomb's information. If for some reason you can't scan this QR code, that offer will be in the email as well for any last minute entries. So I'm hoping that you all will take advantage of that and talk to an expert to help with your specific situation. We will see you all in hopefully next time that we have our next webinar coming up next week. We'll put in an invite in the follow-up email for that as well. So thank you all for joining, and thank you to our experts today for coming on. And I think you all did a fantastic job splitting it up and getting all the information. This is a great update. I certainly feel more updated and less hopeless, I think. So thank you for that. There are definitely more options than you think. All right, everyone. I hope you all have a wonderful day. We'll see you next time. Take care. Bye.
Bye.